Okay, before we move on, I just want to wrap up a few things. So we know that from our previous discussion, under the Keynesian model, a change in money will eventually affect income, and where interest rate would be the link in between. So far in the previous discussions, we look at the relationship, the link between interest rate and aggregate demand, like how a change in interest rate will affect the different components of aggregate demand or aggregate expenditure. So what we're going to do now is to look at the other link, the first link, which is the relationship in money and interest rate. How a change in money will then affect interest rate. Okay, so the Keynesian, they mentioned that the quantity of money will then affect interest rate. Individuals, household, they would hold financial assets. There are basically two types of financial assets. One is money and the other one is bonds. Okay, so money would be the currency that we use in buying and selling, and all non-money assets, okay, just to simplify things, we're going to call them to be like bonds. Okay, so so basically there's a kind of a line, a continuum line, where money would be perfectly liquid, just like water, like you can easily use them for buying and to exchange your resources, economic resources, while bonds would be less liquid. It takes time to like ice, to become a liquid, to become water. So it is less liquid. Okay, you can't just take a bond and bring it to the cafeteria and buy your meal with a bond. Okay, so you need to somehow change the bonds to money first. Okay, so the household, they will have to decide how to hold their financial assets. So this would be their portfolio. There are only two items in their portfolio, so they could only hold their wealth either in terms of money or bonds. Okay, so what will determine this, like how much of their financial assets should be in terms of money and how much should be in terms of bonds? So Keynesian used the term liquidity preference. Liquidity preference basically refers to the demand for money, the household demand for money relative to bonds. So the household, they will compare these two between money and bonds. So their liquidity preference will then determine the proportion of their financial assets in terms of money. Okay, so basically we can use this equation, this identity, where the wealth, okay, of a household, okay, is made up of bonds and money. Okay, so basically your wealth that you have can only be held in either one of these two types, one of these two forms. Either you hold them in terms of money or in terms of bonds, non-money assets. Okay, so then Keynesian come up with this framework to establish the relationship between money and interest rate. So firstly, okay, Keynesian hold that money supply is being determined exogenously by the central bank, by the government, so which is the central bank. So the central bank doesn't need any reason, they simply decide how much money that they want to supply at any time. So the equilibrium interest rate will then be determined by the intersection between the vertical money supply and the downward sloping money demand curve. Okay, so money demand curve is downward sloping, so the intersection between these two curves will then determine the equilibrium interest rate and the equilibrium money, quantity of money. Okay, so why downward sloping money demand curve? Okay, for the exogenous, for the vertical money supply line, that will be really easy because we're going to assume, Keynesian assume that money supply is exogenously determined by the central bank. However, for the money demand curve, Keynesian have very nice explanations why money demand, okay, the total amount of money demanded by household has a negative relationship with interest rate, okay, which we will discuss next. Okay, now we would like to look at the Keynesian explanation on money demand. Okay, so remember, we have shown before that the demand for money is negatively related to interest rate. Okay, so Keynes said that there are basically three reasons why people want to hold money, okay, their financial wealth, either in terms of money or bonds. So there are three main reasons why people would like to hold money instead of bonds. So the first one would be transaction demand. Okay, so this is because we use money as a medium of exchange. So some portion of your wealth, you would like to hold them in terms of money because you want to use money in order to buy goods and services. Okay, so that's the currency, you know, the easiest thing that people accept. Everyone accept that as a medium of exchange. Okay, so the transaction demand is based on your planned transactions. Okay, number two, people hold money, you know, more than what is required as a medium of exchange, but sometimes you still hold more than what is required for your planned transaction because of uncertainty. Okay, unexpected transaction, something that might happen that requires you to spend a bit more. So in this case, you would like to hold, you know, extra amount of money just in case something happened. Okay, for your unexpected, you know, or unplanned transactions. Okay, so number one and number two, these two motives, these two reasons, they are positively related to income. Okay, as your income goes up, basically you hold more money. Okay, you tend to hold more money. You will use more money for your planned transaction, and you will hold more money for your unplanned transaction. So 1 and 2 basically have no relationship with interest rates. Okay, so now what is the motive that can explain the negative relationship between money demand and interest rate? Would be the third motive. Okay, the third reason, which is the speculative demand. Okay, the speculative demand for money. Okay, so Keynes is basically asking a question, you know, plus, you know, this after 1 and 2, why people would still like to hold more money than what is required. Okay, why? Because, you know, when you hold money, you will not receive anything in return, because money will not give you interest rate, while bonds, okay, if you hold bonds, you will receive interest rate in return. Okay, however, you know, although people receive interest rate in return, but, you know, people will still basically, you know, want to hold money more than what is required for these two motives. Okay, so basically they are kind of like willing to sacrifice or let go certain, like, you know, not hold as if that they are not holding the optimum amount of bonds. Okay, why? So Keynes saying that because the future is uncertain, because we don't know what would be the interest rate in the future. Because whenever you hold bonds, whenever you buy bonds, the payment will come somewhat later in the future. Okay, so this interest rate sometimes it is not certain. Okay, it might change because of something. Okay, so because the future is uncertain, if you expect, you know, there will be a capital loss, okay, where the capital loss is greater than the interest payment, so in this case it will be better for you to hold money rather than incurring this loss. Okay, so we're going to look into more detail at this third, you know, the third objective, the third reason. So this is the reason that explain the negative relationship between money demand and interest rate. We want to look at the third reason. I mean, like the third reason why people hold money. That is basically, you know, the thing that explain the negative relationship between money demand and interest rates. Okay, remember, we still want to look at the first link. Okay, between a change. How come a change in money can be, you know, can then change interest rates? Okay, so this is basically because of the third reason. Okay, so under the second speculation demand for money. So we know that in the household portfolio, the household can only hold either one of these two. So either money, which give no return, okay, zero return, but then it is, you know, riskless. There's no risk associated with holding money, because everyone will accept it, and the household will not gonna be, you know, basically at loss. Okay, if they hold money. However, holding bonds, you know, will give them interest rate. They will receive interest rate payment. However, it is risky, because interest rate, you know, is volatile. It can change, and that will affect, you know, the expected return on holding bonds. Okay, so for example, let's say we're gonna assume that the bonds are perpetuity bonds. Okay, so let's say, you know, you purchase a $1,000 bonds, a 1,000 perpetuity, which promises to pay a coupon payment of $50 every year. Okay, so what would be the interest rate? So we simply take, you know, this is the formula how to calculate the interest rate. So we take the coupon value divided by the price of bond. Okay, so in this example, since the price is $1,000 and the coupon payment is $50, so the interest rate is 5%. Okay, so basically, if let's say, you know, throughout the years the interest rate remains at 5%, basically the household will not receive, you know, will simply get a stable return from holding the bonds. Okay, however, because of uncertainty, you know, next year interest rate might either go up or down. So let's say, you know, we assume that there is a shock where interest rate has gone up from 5% to 10%. Okay, so when this happens, so we can you know, we can check the price. Okay, now would be $50 coupon. divided by 10% interest rate. So now the new price of the bond is only $500. So basically, if you hold this bond and then you want to sell it to someone else, you want to liquidate it because you want to buy something, so you need to somehow liquidate the bonds, change it into money. So basically you have to sell the bonds to someone else. Okay, so you can only sell it at $500. Okay, because the interest rate has gone up. Okay, so we can look from here, whenever interest rate goes up, price will go down, and this leads to capital loss. Okay, it is no longer profitable for household to hold, their financial wealth in terms of bonds. It means it will be better for them if they hold in terms of money. Okay, on the other hand, if interest rate goes down from 5% to 2.5%, so now the new price will be $50 divided by 2.5% interest rate, so the price is now $2,000. Okay, so $2,000 now, it is more attractive. People would like to hold more of these bonds, so the price will go up. In this case, you expect to have a capital gain. Okay, capital gain from holding bonds. Okay, so now from here, you should be able to take note that whenever the people expect that there will be a rise, for example, a rise in interest rate, and so they expect that holding bonds will incur capital loss. In this case, they would rather hold money. Okay, and if they expect that interest rate gonna go down, okay, so when interest rate goes down, remember the price will go up, so this will translate into capital gain. So if they expect the interest rate to go down, so they will be willing to hold more bonds, okay, and less money, because their financial wealth portfolio can only be in either one of these two types, either money or bonds. So in the second case, okay, since expecting interest rate to goes down will lead to capital gain, so household will be willing to hold more bonds and less money. Okay.